Hi, all. Welcome to week 11 of the economics of cryptocurrency. Let's jump right into it. So, as I do sometimes, I wanted to show you guys an article from the Wall Street Journal. This is very interesting in relation to some things we've been talking about. So, this person, the comptroller of the currency, Jonathan Gould, has been working on sort of changing regulations to allow more cryptocurrency-like firms become banks or get certain um, benefits that banks get in our financial regulatory system. I'm not going to go to the details of this article, but some of it, I'll mention one thing that's interesting is that some of it involves the banking industry, the traditional banking industry saying, whoa, whoa, probably for competitive reasons, right? Probably because they see new crypto firms as competition in the financial industry that widely is controlled by large traditional banks. And so, if you like the sort of institutional side of cryptocurrencies, that could be a very interesting article for you to read. So, that was an interesting one. I thought it was very interesting. I read that one this week. So in terms of the content of the class for this week, and really next week as well, we're going to be looking at this paper called Microeconomics of Cryptocurrency, which you have access to on the Canvas page. You do not need to read all of this paper. It's pretty long. I think I've asked you to read sections 3.2 through 3.4 approximately, and you can see that in the weekly overview for this week. And we'll be looking at this paper both this week and next week. The math is, I simplify a little bit the math that's shown in the paper, but you can handle the math, I think, in the paper. You just have to kind of read it carefully to make sure you understand the assumptions about the different variables that are occurring in this paper. But what I'm going to show you this week widely relates to this paper, and most of the math is from this paper. I will ask you about things related to this paper, most of which I will cover in class, but it is worth it for you to at least skim those sections of the paper. So here we go, the week 11 collab, the microeconomics of mining, consensus, and attacks is what we're going to cover today. In my upper division economics courses, I always like to remind students about what I call the golden rule of economics, which is that marginal benefit equals marginal cost. Hopefully, this is something that came up in your microeconomics course. And this is a general rule that is often applied across microeconomics and many different branches of microeconomics, including in the economics of cryptocurrency. So just a quick reminder of the intuition on the margin, and economists always like to think on the margin. The marginal benefit is what I get, what I receive beneficially if I do a simple, this isn't precisely right, but it's okay to think about it this way. If I do one more. So in microeconomics is if I produce and sell one more unit, what is the benefit of doing that? The revenue I receive from the unit. In in order to optimize, so in that case, and to maximize profits, I would want to set the marginal benefit equal to the marginal cost of that action. How much money came out of my pocket in order to take that action? So in the common setup in microeconomics, in a competitive market, my marginal benefit from selling one more unit is just the market price because that's what I receive from selling the unit. My marginal cost will be given by my technology. How much did it cost me to make that unit? So we want those to be equal because if the marginal benefit is greater than the marginal cost, then I should keep going. I haven't reached the top of the mountain yet, as we might say. I'm still going up in profits if my marginal benefit is still higher than my marginal cost. So I know I must not be optimizing if marginal benefit is still greater than marginal cost. On the opposite end, if my marginal cost is greater than my marginal benefit, then I should have not taken that additional action. That means the market price in that simple example is less than the cost of that I gave up to make that additional unit. So that probably means I've gone too far if we expect rising marginal costs, as we often assume in economics. that means I've gone past the peak of the profit mountain in that case. So I must not be optimizing if marginal cost is greater than marginal benefit. So what's the only case left over once we eliminate, okay, I'm not at the optimum if I'm in either of those cases. Well, it must be true that marginal benefit equals marginal cost at an optimum. Now, that could be a minimum, so we have to be careful of that. Some of you have taken the math. I think most of you have probably taken the calculus that shows you how we can check that. In general, the assumptions of microeconomics lead us to know that we were at a maximum when this is true. So let's get into the specifics of how that applies to the microeconomics of cryptocurrency. So a lot of what we're going to talk about today is basically the proof of work context and how individual agents, miners namely, optimize their actions within that context. Because we learned in the past, mining on the blockchain involves something called proof of work or a proof of work contest. I'm going to compete against other miners to try to win blocks. Why? Because then I get the transaction fees and I get the block reward. So that's the game that miners on blockchains and specifically the Bitcoin system are trying to optimize over. So let's get into the details of that a little bit. And these are from the paper. So the paper, the Microeconomics of Cryptocurrency paper that I just showed you and you have access to on the Canvas page. So the paper model is proof of work as a contest. Each miner chooses an amount of work. The way you should think of that is a miner invests in computational power that, and specifically computational power that can run hash functions quickly to try to get leading zeros at the beginning of their hash. Because as you already know, if they find a hash with the right number of leading zeros by changing their nonce, was the number that they changed to get a different hash. Because remember, you only have to change something very little, you get a very different hash. So they change the nonce, that gives them a new hash, and then they just keep doing that until they get a hash that's consistent with the blockchain, with the proof of work on Bitcoin, which is the leading zeros in the hash. And we played with that in a prior collab. So hopefully everything I just said reminds you of the collab that we looked at before where we did proof of work previously. So that is the amount of work they choose. And we'll denote that xi in this model as the paper does. And then the rule for selection will be proportional, as you also know. So the probability of a miner I winning a block will be the amount of work they put in, xi, divided by the sum of all the work being put in the system. So their probability is proportional to how much work they put in relative to the entire system. So a miner's choice of winning depends on its share of the total work, basically. And we've seen exactly that thing in a previous collab. So now with that, we can also think about, well, what is the expected value of mining and being in this market at all? Well, the expected value or the expected profit from being in, or payoff of being in this market for miner I will be that probability times R, where R is the block reward. That could include transaction costs. That gets a little bit more complicated because transaction costs are fixed. So it's probably easiest to just think about this as the block reward that's built into the Bitcoin system, which is a constant, at least over periods of time, until it goes down, as you know from the past, in order to manage the supply of Bitcoin, because block rewards in the Bitcoin system are where the supply of Bitcoin comes from. So it's the probability of winning times the reward you get from winning. But then, of course, we need to subtract the cost associated with the choice of work because you have to buy computers, you have to run computers. There's a lot of energy cost there, for example. If you're throwing more computational power at this problem, you're going to be using more energy. So when xi goes up, the cost of mining goes up. In this general form, we allow the cost function that maps computational power to cost to vary by firm, as it probably does in the real world, because different firms or different miners might use different technologies in order to mine on the blockchain. That means that they would probably have different cost functions. In simplified versions of this, like in the paper, we do apply a common cost function. So we assume homogeneous miners, or like we assume homogeneous firms in a lot of models of microeconomics, meaning all of the miners have the same technology that they're applying, meaning that the amount of computational power maps to cost in the same way across all miners. But we don't need that assumption. We just often use that to simplify things depending on the question we're asking. To keep the example in this collab simple, we're going to assume a functional form, and this will allow to vary by miner. At least in this part, we can imagine this varying by miner. So CI will be a constant KI divided by 2, XI squared. That's going to give us an exponentially increasing cost function, which nicely will give us a linear marginal cost function. Another common assumption in microeconomics when we start throwing functional forms at things, we could put different functional forms here. This is really just for the purposes of showing how all of this works out. But that's the one we'll choose for this particular example, just to keep things relatively simple. So this, of course, gives us a standard microeconomic problem. Choose effort until the golden rule holds. So let's make some assumptions down here in the code. R equals 12. We'll have a miner XB who has, or sorry, XB is going to be our miner. The effort chosen by the other miner, because we're going to focus on miner A. So up there we were general, miner I. Now we're sort of pinning, let's have a system with 2 miners just to really simplify things and really see what's going on. Well, because of this probability, we need all of the miners in the system. So we need to assign XB how much work is the other miner doing in order to get the sum in the bottom of this probability. So that's why we're setting that here at 4. KA, that's going to be our parameter for miner A. The miner will be assessing in this block of code. We're setting that K to 0.4 right here, just to get some numbers behind this so we can look at graphs of how this is working out. Oops. But you can change that if you want, and we ask you to change that in the assignment. So then we're just making a grid. Basically, this is just so we can draw a graph of what's going on. And this is going to be the X grid. So we're going to look at different choices that miner A might make so we can find what optimal mining looks like. And then we can go ahead and plot their expected payoff based on their different choices. We get a curve like this here. And we see, okay, the optimum right here is at 2.7 based on those parameters that we said. If we change the parameters, we'd get a different optimum. Now, we haven't done anything marginal here, but it is true that at this point, the marginal benefit of mining, each probability times reward equals the marginal cost of mining at this point. Another way to think about that is the profit function or the payoff function will be benefit minus cost. If marginal benefit minus marginal cost are equal, then that quantity is 0. Or another way of saying that is the derivative of the payoff function is 0 at this point, where marginal benefit equals marginal cost. And that's another way to think about optimization. Hopefully that's a reminder from previous classes for most of you. But as we can see, the slope of this function is 0 at the optimum. We're at the top of the mountain, basically. We're neither going up the mountain or going down the mountain. We're assuming the mountain is kind of flat at the top. And so that's how we know we're at the top of the mountain, is we're at the flat spot. So now we can, based on those parameters we came up with, we can easily calculate the marginal benefit and marginal cost of mining, which we do in this block of code. And then we graph those, and we can see at that same optimal mining amount of X equals 2.7, what happens? The marginal cost, which is linear, remember, because we chose a quadratic cost function. So when we took the derivative of that, we got a linear function. That's why this is just an upward sloping line. This derivative is a little bit more complicated because the probability, because that xi, the thing we're optimizing over, shows up in the numerator and the denominator. So there's some quotient rule action happening there. A little reminder of calculus. That's why this is a bit more complicated of a function, nonlinear. But as we can see, those guys are equal at the optimum of 2.7. So this chart expresses the golden rule of microeconomics in the mining context, in the mining context for a proof of work system. So remember, in microeconomics and basic microeconomics, this is generally what we do first. We say, how is this individual firm going to optimize their actions in order to get the best profits? So maximize profits if they're in the market. The second question in microeconomics we ask is, should they be in this market at all? Should they enter this market? Should they exit this market? That is exactly what we will move on to now, which is participation and entry. Participation is kind of at the question, should I be in this market at all? Should I be participating? Should I enter the market? That's what entry refers to. I should go and start participating in that market. Or the opposite of entry, of course, is I should get out of this market. It's not worth it to be in there. What we're asking there is really, is this a positive number? So as we can see here, this is a slightly positive number. So that means either, yes, you should be in that market, or you should enter that market because there's positive economic profits available to you in that market. So in this case, this miner does want to be in that market because this is just a little bit above zero. So there are positive economic profits there. We can see that if they weren't optimizing, that appears like it would be quite problematic for them, because if they're not here, they're getting to negative territory really quickly. So that's going to be a different equation that defines that, as a different equation defines market entry in basic microeconomics. So in the specific context of mining, we'll add a couple additional assumptions here. First, we're going to assume that all miners are alike, so that they're going to choose, if all miners are alike, then they're going to choose the same amount of mining power. That's not true here, by the way, because remember, we pinned the other miners' effort at 4, but then we found that miner A would choose a different amount. So that assumption actually doesn't even hold in this section right here. But as the paper does, we'll make this simplifying assumption that we have homogeneous miners. And so all of those miners are going to do the same thing, which means that the probability is going to be equal across miners. And then that's going to simplify our probability of winning to 1 divided by capital N, which will simply reflect the number of miners in the market. Each of these faces fixed cost C. So that's like, before I even start using my computers, I got to buy a bunch of computers that I will then run in order to mine. Running the computers is like the variable cost of mining. Buying the computers in the first place is the fixed cost of mining. We will denote that by C. Here, notice that C does not have an I on it. Why? Because we're assuming all of these miners face the same technology, are exactly alike, and so we don't have to index that by I. And now the expected payoff for each miner is approximately reward divided by N, because that's 1 over N, the probability multiplied by the reward, minus the cost here, that fixed costs. If that's a positive number, then you want to enter the market. If it's a negative number, you want to leave this market. If it's a free market and a competitive market, we'd expect this to hold with equality in the long run. Miners will continue to enter, which will decrease the probability and decrease the benefit. Eventually, that benefit of being in the market will be equal to the cost. And that's in the long run, economic profits are zero through the action of entry and exit and participation in markets. So hopefully that's a good reminder. That's a general thing about microeconomics, is that the reason long run economic profits are zero is that miners will continue to enter until the benefit to entry is zero. And that's what drives economic profits to zero. Now, a reminder about economic profits. Economics profits include opportunity costs. So we're not saying everybody makes $0 in any given market. What we are saying is that, okay, well, I can take my computers and I can be a miner on the Bitcoin network, or I can take my computers and I can do data analysis in the information market. Well, if I choose the mining market, then that data analytics market is my opportunity cost. And I need to subtract the benefit of being in that market from my cost. So both of those can be profitable in the accounting sense of profitability, but both, if they're competitive, we'd expect zero economic profits. Which another way of saying that is we'd expect accounting profits plus non-pecuniary benefits, like mining is funner than data analytics or something like that. I don't necessarily think that's true, but those benefits also are captured in economic profits. And we'd expect those to be equal in long run equilibrium across all markets. Now, a little philosophical question, are we ever in long run equilibrium? Probably not. But that's okay, because the benefit of equilibrium thinking isn't because we believe we're in equilibrium. It's all about what do we expect human actions to occur, or what human actions do we expect to occur because we're not in equilibrium. And that's what really gives economics its power. The fact that we're not in equilibrium, but we should expect movement towards equilibrium under certain assumptions. So we'll do a simple free entry benchmark. So here's just some code showing how this might work in our little made up market. If we have zero, or so on our, this is the 0th row where we have one miner. If we only have one miner in the market, they have a 100% probability of winning blocks. So they're very happy. This is positive profits. What do we expect? Other potential miners to say, hey, there's positive economic profits over there. I'm going to go ahead and enter that market. So now you have two miners. The probability for each is less. So now we have a slower expected payoff for miner. It declines, declines, declines. We end up at zero. So this is our long run equilibrium number of miners in our little toy model that we have here. Okay, now consensus as an equilibrium. This is where the paper actually gets hopefully a lot of that was basically easy to understand, relates very simply to basic microeconomics. Now, what gets interesting in mining is we need to have some consensus and cooperation. There might be incentives to cheat on the blockchain. And what the benefit of this paper that I've showed you earlier is that it gets deeply into, and papers that it talks about. So it's not just all of this was done in that specific paper, but that paper is in a journal called the Journal of Economic Literature, which oftentimes collects all the previous literature and summarizes it. And one of the things they summarize is called the Budish condition, which we'll go over here. And this is about, is it possible to have an equilibrium where miners don't want to cheat, or what would that equilibrium look like? Because the next place we're going in week 12 is, how do we design a system where we minimize the total cost of having this decentralized cryptocurrency and the benefits that we've talked about that come with that? How do we get that at the lowest possible cost? Well, keeping it secure. Because it's going to turn out that though there's a trade-off there. More cost, more security. But we care about costs. So we don't want to just have super high costs to maintain security. We essentially want the lowest cost system possible that also maintains security. And this is where we get really into more of the specifics of how the Bitcoin blockchain and similar blockchains work and think about this particular problem, or this particular trade-off, I should say. So as you already know, the longest chain rule is built into Bitcoin's protocol, but the paper that we're covering now asks a deeper question. Will miners actually find it optimal to follow that rule, to follow the longest chain rule? Because we need these decentralized miners who are not coordinating with each other to follow this same rule in order to get a blockchain, a cryptocurrency blockchain that actually works and people will use. So the literature shows, so they do sort of a literature review because there's a few different papers that ask that question. The longest, so one thing that that paper shows, or some of those papers show, is the longest chain rule can be what's called a Nash equilibrium. A Nash equilibrium, because maybe not all of you have taken that. I'm not sure, but there might be a mix of you. Some of you may have seen that, others maybe not. As a reminder, a Nash equilibrium is I have no incentive to change my actions given the actions of the other players of the game. So now if I am a miner on the Bitcoin blockchain, and we're in this particular longest chain rule Nash equilibrium, I don't have an incentive to cheat as long as everybody else is also not cheating. However, that doesn't mean we're good to go and we can move on, because there might be other Nash equilibria that are not so good, because this one's a good one. Everybody's following the longest chain rule, and we have a well-functioning cryptocurrency system. Okay, cool. Wait. I don't think I just deleted anything. Well, maybe I did. But there may be also other equilibria. So that's what I was just getting at. This is the good equilibrium that we want, but there may be other equilibria. And those other equilibria would be not so good. They would likely involve cheating in the cryptocurrency system, making it less secure. Bad actors, basically, would be involved in those other equilibria. Strategic forks, which would be a bad thing, can sometimes be sustained. So somebody might do something like, I'm going to go mine privately. So I'm going to sit here and I'm going to produce hashes. And I'm going to make my own secret blockchain. But it's going to be consistent with the basic rules of the Bitcoin system, meaning my hashes are going to have leading zeros that are consistent with the rule. I could privately have a race with the main blockchain. And on my private chain, I could give myself a bunch of Bitcoin. I could make transactions that put Bitcoin in wallets that I own. And if I can somehow figure out to make my private blockchain longer than the true blockchain, then I can all of a sudden make mine public. And because the longest chain rule is the rule, when I suddenly make mine public, other miners will say, hey, this is the longest chain. This is the one we should be mining on. So the question is that feasible? Would any individual find it feasible to do this private chain, race the public chain to try to beat the system and basically cheat on the system in a way that they could benefit financially from? So a longest chain attack works as follows. An attacker begins mining a private chain that differs from the public blockchain. For example, excluding a transaction that they want to reverse. So maybe I promise, hey, I'm going to give you a bunch of Bitcoin for a Ferrari. But then on my private chain, and I put that on the public chain. But then on the private chain, I reverse that transaction and give myself my Bitcoin back. So instead of publishing their blocks, they keep them hidden while continuing to mine. If the attacker can build this private chain faster than the honest network builds the public chain, they will eventually produce a longer chain. At that point, they can release the private chain into the public, and under the longest chain rule, the network will adopt it as the canonical history. This effectively rewrites recent transactions. This is obviously, for reasons that you already understand, a problem to a blockchain-based cryptocurrency system. we analyze when the longest chain attack is economically profitable. The key idea is to compare the benefit of attacking to the cost of sustaining the attack. So definitions here, the Budish condition can be written as, so this is what we're going to get to at the end, the reward times this parameter called A minus 1 times T is greater than or equal to the value of cheating, basically. In my example, the value of cheating is me getting my money back for the Ferrari that I wanted to buy. That would be my private value of cheating. This is the cost of cheating. So that is the more complicated side, obviously, of the calculation here. This is a little bit simplified from the paper. So that's one place that a good thing for you to do as you're reading the paper, take a look at how I simplified it, which I'll hint at here. But R is the reward to honest mining. So why is that part of the cost? Well, it's the opportunity cost of cheating. If I have so much computational power that I can beat the system, that means I also have enough computational power to essentially win every block on the honest chain. I'm giving that up by choosing to cheat. So that's why that shows up at the cost side of this equation. A is the attacker's mining power relative to the honest network. We assume that A has to be greater than 1, where 1 is just a placeholder for representing 1 is the power on the network. A has to be bigger than 1 because in order to win, in order to beat the longest chain on the network, you're going to need more power than the total power network, or at least that's the assumption in the paper. So for example, if A was 1.1, that means that this potential cheater has 10% more total power than the entire honest network. Probably you would need more, or possibly you would need more than that probably to beat every chain, but we're going to assume that you win every block because that will make the chain true. That means that the cost will be higher in any cases where you don't win every block because you're not going to get as many rewards when you're if you decided to go honestly. So A has to be more than 1 for this equation. This would be negative if A, of course, wasn't greater than 1. Now here I mentioned, so this is slightly different. I've simplified this. This is the block reward. Here the paper uses E, which is the exchange rate, which you could think of as dollars per Bitcoin or euros per Bitcoin, times theta is the actual Bitcoin block reward. So in the paper, that can be important to think about because that means that R is smaller when Bitcoin's price is lower. R is bigger when Bitcoin's price is higher, when Bitcoin's price is a more valuable commodity, basically. And that's why in the paper they divide those two, which allows us to think about the action of both the exchange rate and the block reward in Bitcoin separately. But for our purposes here, we're just calling that the reward. T is the number of confirmation blocks or the time before settlement is treated as final. So sort of the status quo on Bitcoin is 6 blocks. So if I bought my Ferrari, the Ferrari dealer might say, okay, I'm not going to confirm this transaction until I've seen your transaction is 6 blocks deep into the blockchain. And that's called the settlement period on the blockchain. Because for reasons you might remember, even if the blockchain is working with only honest miners, we still want this settlement period because some blocks might become orphaned, as you've seen before, if 2 blocks show up at the same time. So oftentimes we want some time before settlement. If we have an average of 10 minutes between blocks, then having 6 blocks makes the average settlement time about an hour. Then, as I mentioned, V is going to be the private benefit of cheating on the blockchain. So if this condition holds, then cheating does not look good. Because if this condition holds, that means the cost of cheating is greater than, or at least as big as, the value of cheating. And so if that condition holds, then we should basically expect an honest network. So this is just explaining why A is greater than 1. What does A mean? A is a measure of how much mining power the attacker controls relative to honest miners. So examples, 1.1 I already mentioned, and this is just for your notes to really, because A to me was a little bit weird to interpret when I read the paper. That's why there's this extra stuff about A here. So a larger A implies more control is needed, which implies a higher cost. And that's why A enters positively here. If you need more A to attack the network, then the cost of cheating is higher. So just here, what does T mean? T is the number of confirmation blocks, as I mentioned, or the settlement period is sometimes how that's referred. This matters because the attacker must replace all of those blocks. If T is bigger, it's going to be harder to cheat on the network, basically, because you're going to have to maintain this extra computational power to beat the network for a longer period of time to the extent that T is bigger. So the left-hand side, A minus 1, how much extra mining power, this is the cost again, is required. So more A, higher cost. How long the attacker has to sustain effort. If you have to sustain that computational effort for a longer period of time, you're going to have a higher cost. R, again, is the opportunity cost of not mining up honestly, because during that time period, you could just be on the network earning block rewards. Because by A, you have enough computational power to beat the network. So because that's the assumption about the meaning of A. And that means, hey, you could just be winning every block on the honest network. You're giving up those block rewards on the honest network when you're trying to cheat on the network. So R is also part of the opportunity cost of attacking. So right-hand side of that equation is the benefit of that inequality is the benefit of attacking the network. That's just V, that one's easy. That's just our stand-in for the benefit of attacking the network. That could mean different things in different contexts. Like it could mean reversing a payment, like my Ferrari example. It could mean double spending. I'm going to take the same Bitcoin and spend it in 50 different places. Extracting value from a transaction that would otherwise be final. And we can actually imagine a bunch of different ways that somebody might attack the network. One really interesting institutional one would be, what if Bitcoin becomes so popular that the Federal Reserve starts worrying about competition between the Bitcoin currency and the dollar itself? Well, they might have an incentive to say, okay, we need to shut down this network. How might we do that? Maybe we'll throw a ton of computational power at it and attack it, which would be one way to shut down Bitcoin. So now we can think about how this plays out, throwing some different parameters into that inequality. We can have the return on attacking, basically. So if the attack value gets higher, then the security margin is higher here, so that its security is true. But then eventually, if the value gets really high of an attack, then it would be false. And here are values where we would expect attacks to occur on our very simple toy model. And then we could plot the minimum reward flow needed for security, because now we see that there's a relationship between the reward and attacking the network. This is very important to think about for the evolution of Bitcoin. The reward, the fixed reward, the block reward was highest at the beginning of the Bitcoin network, and it declines over time. That's how the supply of Bitcoin is controlled, and we know in advance what the ultimate supply of Bitcoin will be. That's one interesting thing about the block rewards. But now we see that block rewards relate to attack incentives. Eventually, the block reward will go to 0. So then what will R represent? when block rewards are zero, only transaction costs. So if people are, or transaction fees, but those are voluntary on the Bitcoin network. So now you have a very sort of interesting situation where if people are not putting high enough block transaction fees, that means that R is going to be low, and R impacts the cost of attacking. If R is low, the cost of attacking is lower, and that could become an issue. So that's something people thinking about the Bitcoin network in the long run think about a lot. Will transactions fees on the network be high enough to keep the Budish condition held so that there's not incentives to mine the network? And in this last block of code for the video lecture, we can just draw out different private benefits of attack along the x-axis, different time escrow periods. So we see that we need, if we're only going to do one block to confirm transactions, would lead to more efficiency. Transactions are happening more quickly now, but you need a higher reward for security. That, of course, then depends on the value of attack. If the value of attack is really high and you're only doing one block confirmations, you need really high rewards to maintain honesty on the network. However, if you increase the escrow period or the settlement period, then you can have relatively lower block rewards and maintain security on the network, even for high values of an attack. And so this shows how there's a trade-off between escrow periods, block rewards, and how those vary, what you need in terms of the design of the system, because these are design parameters when I'm building my cryptocurrency system. These are more related to, well, how are people using your cryptocurrency system, probably will feed into what are the benefits of an attack. But now you can think about this trade-off in design and how that relates to different benefits of an attack. So here's just a summary of basically everything I just covered. Don't hesitate to reach out to me if you have any questions. Where we're going next is, okay, now how do we optimally design a system that minimizes cost but maintains security? All right, and that's where we're going in week 12. So good to see you, or for you to see me. I would like to see you. So if you want to meet and chat about anything, don't hesitate to reach out. And I will see you on the flip side.